we'll get straight into the presentation. So if we can move to the slides, here we are. We are going to be looking at today what assumptions are we using as a rating agency? How have they been translating into rating actions? How have the forecasts actually compared to what's happened? Because we obviously started this about 6 months ago. How are we viewing liquidity right now? A question, probably the number one question I get, when are the ratings going to stabilize? And then last but not least, before we get to the Q&A, best and perhaps the least best Treasury responses to the crisis so far. So if we start with what assumptions are Fitch using, you'll have seen, I'm sure, many charts like this. This is simply showing the level of decrease in GDP in 2020 that we expect to see across a whole range of countries. The UK is just to the left-hand side of the screen there. You can see the US slightly further to the right. The only major economy we see this year with any kind of positive GDP growth is China. Really kind of not exactly unexpected there. One slide I did want to sneak in, because there was a very good presentation on Brexit earlier today, was if you look at the Brexit situation, the impact of Brexit relative to all those fairly scary numbers that we just saw it's relatively minor, but it's not negligible. It is going to markedly slow, and I would stress here, Fitch's assumption right now is a WTO only exit, so we are not assuming an FTA at this point inside the ratings. Now that would markedly slow the recovery we're seeing post-lockdown. It adds about 1% unemployment, adds about 2% to debt to GDP. And in terms of the actual credit rating of the UK, our sovereign colleagues, I thought it'd be interesting here just to put up a little display of where the major European countries are right now in terms of their ratings. And you can see that the UK right now, I think we all remember when the UK lost its AAA rating. We are now at AA minus outlook negative, so we are actually at the bottom of the AA category. So that gives you some sense of the context of where we sit against our nearest European neighbours. But if we move away from the macro level there, or the sovereign level there, and we think about how we addressed corporates. So if you look at the top chart there, that's the chart that we designed back in March. So that was when we were trying to work out whether or not we were trying to work out the general trajectory of what was going to happen with this unprecedented multi-month lockdown of the economy. Then it came to June, and we sat down and we did a more detailed analysis on a sector-by-sector basis globally, and I think that that file is available for download from this site as well. And you can see that curve pretty much mapped to the curve that we came up with in March. And we'll go into a little bit more detail about where that curve came from. You'll actually see there's two curves on the bottom one. This is a dollar-weighted curve of all corporate revenues that we rate, and we rate about $14 trillion worth in debt. It's probably about 20% of the world's all over corporates, everything down to corner shops basically. So if you look at that, you can see there are two lines. One of those lines, a slightly higher line, is the non-oil number, and we'll get to why I've used a non-oil and an oil number in just a second. But those curves were very significant. So that curve that we came back with on June implied something like $8 trillion of revenues disappearing from corporates over the course of 2020 and 2021, with corporates generally not getting back, in many cases, to their 2019 position until after 2021. Now, this does have a lot of double counts. This is not like a GDP number. This includes, for an Xbox, the guy who makes the packaging, the guy who makes the semiconductors, the guy who makes the shell, and Microsoft who make the IP. So there's a lot of pancaking in this number, but it is comparable, as I say, to the $14 trillion worth of debt that we actually assign credit ratings to. Very, very substantial financial difference there, obviously. If you break that down into sectors, and this is why we had an oil and a non-oil line, you can see there the largest single sector by a substantial distance was the oil and gas sector. That was a very, very large chunk. And you can see on the left-hand side there, the pie chart that shows you global distribution of those revenues and how much was hit. So oil and gas, very big chunk, almost half the revenues. But you can see there as well, it's a very large sector in dollar terms. Next to that, manufacturing, A lot of that was autos. But look at leisure and transport. This is a very small rated sector in relative terms, but well more than half of the revenues disappear for that sector in our projections over the 2-year period. And we'll get to, this was our June projection, we'll get to what our projection now is in just a little while. Relativizing across the globe, because we did do this on a global basis, Europe, or EMEA to be more exact, does come out worst. A lot of that is because the largest international oil companies are now headquartered in Europe. And we also rate all the major Middle Eastern oil companies that fall under the EMEA headline. So the oil impact there was pretty substantial. And you can see here in regional terms, Asia actually has the least impact, which again won't be surprising to people. That dip you see for Asia, that happens every year. That's the impact of the Chinese New Year. But otherwise, you can see Europe comes out worst affected nominally there. But if you look on the right-hand side, this is an interesting thing. This is actually how the sectors break down by the rated universe. So given your economy might not actually be equally rated across all its different sectors. So a lot of sectors just don't get credit ratings. So in Europe, for example, not much in the way of retail or leisure names have credit ratings. In the US, there's a lot more of them. So that also, when you hear about rating news for different regions, plays a lot into how the ratings, how the rating mix and how the revenue decline is pictured. So how did that, all these forecasts, very nice, how did that translate into actions? You can see here, this is a chart of our rating actions since the start of the year. Really an important point to mention here, about 30%, we've had over 700 downgrades so far this year, about 30% were not coronavirus driven. There has been a long run negative corporate rating trend. In the last 100 months before the coronavirus outbreak, there were 78 months where we had more downgrades than upgrades globally, and there were about 12 or 13 months where it was equal. So very, very few months where there were more upgrades than downgrades. And this has just continued that trend. We're still seeing M&A, we're still seeing underperformance, and we're still seeing, particularly in emerging markets, liquidity pressure. Just one thing to stress, 700 downgrades. There have also, however, been almost 600 affirmations. So that's ratings that didn't change at all in the course of the year so far as well. This gives a little bit more detail. I won't go into too much detail on this. This gives you a breakdown by sector. You can imagine which sectors are the most affected: consumer, natural resources, leisure, transport, entertainment, some manufacturing names as well. The bulk of actions were in speculative grade. So the lowest ratings saw the bulk of actions. You can also see there we've had almost 30 fallen angels. That's what the market calls a rating that moves from investment grade, BBB minus, to below investment grade. So 29 fallen angels is more than we've ever seen. It's probably at the low end of the expectation we had back in the spring. More significantly, perhaps, there's a cutoff point between B minus and CCC. CCC is when you enter the distressed range for ratings, and we've seen 100 names fall into the CCC range since the start of the crisis. So all of that was, we started with, we had a curve. We looked at what we thought the sectors were going to do as a general trajectory. We then had to turn that into individual forecasts. So for every company that we rate, we have an individual forecast, which the analyst develops, which then generates financial ratios, which we compare against our thresholds. And what we were saying was, if you're inside your headroom for the rating, if you're inside the thresholds for the rating category, by the end of 2021, then there wouldn't be any rating action. So you saw a lot of those affirmations there, 600 affirmations. They're mainly staying inside their existing thresholds by the end of 2021. But obviously our forecasts are just that. So how have our forecasts panned out compared to reality? Well, this is, we're going to take the aggregate picture for a moment for Western Europe. Then we're going to talk a little bit about individual sectors. And you can see here that, again, it was really quite a substantial aggregate hit. So that's a 17% hit compared to what our previous forecasts were for Western Europe in 2020. And another, I think that says 11% hit, that's right, in 2021. And then a 6% hit again in 2022. one thing I should stress, and we are seeing this with our default projections too, is we do see this rippling on into 2022. So that was the estimates on revenue reduction. So that was at the top line level. Again, a lot of that is down to natural resources. If we look at the sectors, leisure, transport, and oil really are seeing the most long-lived effects. This is done on a percentage basis, so it ignores the fact that leisure and transport is a relatively small part of the rated portfolio in Europe. Again, retail is a sector that we have seen facing problems before we came into the pandemic. It was the sector where we saw the most high yield defaults last year, and we were anticipating seeing the most high yield defaults coming into this year as well. So retail, again, not a great surprise there, exacerbating an existing trend. Now, this is a really interesting slide. So again, what we did here was we took all the forecasts, and the analysts have been busy updating their forecasts every week as we've gone through the crisis. And you would have expected, certainly we expected, with that type of revenue cut, we expected to see more damage done to the EBITDA line, because obviously there's a certain amount of costs that are always going to be fixed. And actually what we're seeing here is a relatively modest, given the scale of revenue hits, relatively modest, as we update our forecast based on feedback from companies, hit to the EBITDA line. Again, 12% this year and 11% next year, slightly more in 2022. Now, these are forecasts that our analysts develop with input from the issuers that we rate, but obviously it's our decision, it's our judgment. So we are clearly seeing some quite impressive feedback from companies as to how much they expect to be costs, and we are going to get to that as our polling question in just a few minutes. But the EBITDA projections that we saw there prompted a bit of skepticism internally. We have, however, seen in the results through Q2 that in fact we are seeing companies generally arriving where we thought they would on the revenue line, but being slightly better positioned on the cash flow line. So companies, when we're seeing the actual results coming out compared to even our revised forecast, companies do seem to be doing relatively well, underlining the flexibility of corporates as an asset class. Now we can't talk about, now this is a bit of an eye chart, so we're not going to go into individual detail looking at all of the text on these pages. I think the important thing here is just to look at the red line versus the blue line. I'm just going to double check that we are talking about the, so the blue line is the original forecast. That makes sense because this is airlines, and you can see the red line is now below the blue line. So what we're saying here is when you look at our road back analysis, where we said this is how we think things will go until the end of 2021, airlines are undershooting what our expectation was back in June. No surprise there. If we move on to lodging, a similar story, actually undershooting by more. Their line is getting closer to the airline trajectory that we saw earlier. There are there's differentials here with airlines. We're seeing budget and discount airlines having a better fist of it than long-haul international airlines. Similarly with lodging, budget hotels are going to do better than hotels that obviously rely on business travelers. But you can see that there's quite a substantial change in our level of forecast for the lodging sector relative to even where we were in June. Most of the sectors, though, we are actually seeing a little bit better performance than we anticipated. This is discretionary retail. So we split out food retail and discretionary retail. And you can see here the red line is actually doing better. So we've revised up our projections relative to the blue line, which was our June assumption. So we are seeing signs of better performance in the discretionary retail category here. If we look at another similar story, capital goods. So this is essentially most manufacturing except for autos, which we address separately. Again, you're seeing here we have actually, with the exception of aerospace, seen a better performance, and we have revised up our post-lockdown trajectories compared to what we were thinking in June. So that's a reasonably positive story there. Property companies is interesting. Now we put here retail sector properties in particular. We have just published a series of reports. There are 3 reports, one on retail, one in the office sector, one in the logistics sector, so what we used to call industrial, I think. Those, again, I think are available from download from this website. But they have looked at what we think the trajectory is, the collection rates, the vacancy rates, what's going to happen going forward. Office and logistics have done pretty well. We're seeing upwards of 90% collection rates in both those types of property companies. Retail, not so much. And you can see here, based on the red line, we have actually had to revise down our expectations for the retail sector. Now, we do expect a recovery, but it is the most exposed of the property company sectors. Oil and gas. This one probably won't be much of a surprise. When we were doing this back in March, and when you came up with that, when we came up with this really very large hit to oil and gas, obviously oil prices were lower than they are. We have uprated our oil and gas deck. We have a price deck that we use to generate these forecasts. Interestingly, we lifted the near-term prices for 2020, but we lowered the medium to long-term price deck because, again, we think the break-even price continues to come down. So we lowered that below $55. But in the near term, which has been important for a lot of oil and gas companies that are facing, some quite severe liquidity pressures, and we are seeing a lot of oil and gas company defaults in the US. That trajectory's got better. Again, this is an interesting one where when you look at different regions, you get different stories. Most of the small oil and gas companies who have credit ratings, and indeed most of the world's small oil and gas companies generally, are in the US in the shale area now. And what we're seeing is that's where most of the stress is. We've actually been able to affirm the ratings of most of our EMEA oil and gas names, which is the Western European majors or headquartered majors, and the Middle Eastern names as well. Metals and mining, similar story to oil and gas. One of the sectors, I'm not sure if this is going to come up in a second or not, one of the sectors that actually did, if I had to say what was the sector that most surprised me in terms of its performance relative to our expectations, it would actually be the building and construction sector. We did expect to see much more of a dip there. Oops, that's my phone ringing. Hopefully someone will get that. So we had the building and construction sector we thought was actually going to face a much worse slowdown. It's actually done quite well. And as a result of the building and construction sector doing quite well, we're actually seeing here a trajectory, the red line, substantially above the blue line. So that's some good news for the metals and mining sectors there. Metals and mining and oil and gas have a very big multiplier effect on the wider economy. They actually generate an awful lot of ancillary expenditure through their suppliers. So there was some good news in there. You can see oil and gas is doing better than we thought. Some areas of retail and manufacturing are doing better than we thought. It is overall, however, a fairly negative picture. We're still seeing the economy struggling to get back to where it was by the end of 2021. And some sectors in particular are continuing to get worse, notably leisure and transport. There has been one piece of good news relative to March, the first time I sat down and had to come up with the guidance for our forecasts in this room about 6 months ago. And one thing that has gone better has been liquidity. So this is the area of least immediate concern. Government and private sector support has been very strong. If you'd asked me at the start of March, what were my concerns with regards to the markets, I would have said, well, three things could happen. They could shut down entirely. It's an unprecedented pandemic, could happen. You could have a lot of really volatile risk on, risk off windows, and we've actually seen some of those in recent years. Or you could have an almost permanently open spigot. And in relative terms, it's pretty much been the latter. There has been a lot of liquidity available for even the worst affected sectors, even cruise lines, even very discretionary luxury retail have been able to get access to liquidity in most cases. Most of the defaults that we're seeing in developed markets are actually distressed debt exchanges. So that's not a payment default. That's not the company running out of money. It's the next thing I'm going to talk about, which is when that liquidity comes in, there's two things it can do. It can tide you over. So it can fill the gap of a certain amount of time with no revenues coming in, or it can fill in for capitalized losses. So it can fill a gap where no revenue's coming in, only costs going out the door. That equates to a loss, and how much of that debt ends up still sitting on the balance sheet as a capitalized loss. And obviously when that happens, we end up with, when we look at the metrics that we tend to look at, debt to cash flow, you will then see the debt rise, the cash flow perhaps doesn't rise, perhaps falls a little bit for next year's estimation. And that's why the profiles at the end of 2021 are the key thing that we're looking at for the ratings. So again, liquidity in pretty much every market, even emerging markets, has stayed pretty strong. When will ratings stabilize? Now, I believe this is the point where we're going to experiment a bit, and we are going to the polling questions. Yes. So if you would like to, I'm going to see these come up hopefully on my chat window. If you can go to your poll buttons down below at the bottom of your screen and answer polling question 1. How do you expect for your company your spend on production staffing to develop? Do you think it's going to be cut more than in a normal recession? It's going to be cut the same as in a normal recession, cut less than in a normal recession, or are you not cutting? Some companies have actually done pretty well. We have seen some healthcare and some IT related companies actually doing quite well in the pandemic. I was in Curry's yesterday, and I heard them tell somebody not only could you not buy a printer in Curry's yesterday, you couldn't even order one. So some sectors are doing quite well. So you might be one of those sectors who is not planning to cut. So I'm watching my chat window here to see if we get any answers come in for that. This is all a bit of a technical experiment. I think what we'll do is we will give it another 20 seconds and then we'll move on. It might well be logging your answers as we speak. We'll move on to the second question, which is very similar, which is how do you expect your spend on marketing to develop? So this is different from your production spending. It's the same answers. You're going to cut it more than you think in a normal recession, cut it the same as in a normal recession, or cutting it actually less than in a normal recession, or not cutting. So we have the answers for the first poll while you answer the second one. 37% cut the same, 33% cut less, and 19% not cutting. That is very interesting. Nobody is cutting more than a normal recession. That's really interesting. So we've now got the marketing question there, so I presume people are filling in their answers to that too. And we'll move on to the third one while we collate those answers and get them sent across to me. The last question is capital investment. So in some ways, it is the slowest thing to change. It's a bit like turning an oil tanker for some companies. So what's your answer on capital investment? Is it more than a recession, same as in a normal recession, a bit less than a recession, or not cutting? While you're pushing your buttons on the marketing, so there's probably some people who are watching who are consumers of marketing budgets who are interested to know what the answer to this is. 43% cut less than in a normal recession, 29% cut the same as in a normal recession, 14% cut more than in a recession. That is very interesting again, very interesting indeed. So this last question here was capital investment. So it seems that people are slightly more likely to cut their marketing spend than they were their production staffing spend. Probably quite logical. I guess we'll find out in just a second what the story is on CapEx. I'm actually going to take a picture of those answers because that's quite an interesting thing for us to work on for some research. Any second now, we should get the answer. I'll move on to the next slide while we wait for that. And here's the answer. And the answer is on CapEx, not cutting more than a third of you, 35%. Cutting your CapEx the same as in a recession, 29%. Cutting less than a recession, 23%. Cutting more than a recession, 13%. Some really, really interesting answers there. We're going to have to sit and read through that again and try and work out how we get to the bottom of that. Do remember, this is the same chat box. If you've got any questions as I'm talking, do throw your questions into the mix, but very interesting answers there. We are certainly seeing, I'm going to add those up there, The not cutting answer is 19% for production. Nobody, I think, for marketing. And not cutting is 35% for CapEx. So, interesting story there. Moving on with, so how is that relevant for what we do with the ratings? So, couple of things about the curve. One was, and when we were explaining this to investors, the first part of the curve, a lot of companies won't get past that. The fact that we drew a curve doesn't mean that everybody is going to make it past the curve. We did see a spike, a significant spike in defaults in April. Since then, actually, defaults have come down every month. We do expect there to be a lot more defaults next year, but definitely a little bit like the medical outcome of the virus itself, we saw a big spike in defaults in April with companies who just got really hammered by liquidity. And I think a lot of those really was between oil and gas and the retail sector. The other thing, which is what was relevant to the questions that we just looked at there, was this zone of cost caution. And the point here, and we were discussing this with our economists, was if you think that's the line, let's imagine that you think Fitch is absolutely bang on the money. Most companies aren't trying to hit that line, okay? Because all that line does is defray the amount of revenue that you're losing. In order to get some kind of profitability out of this year and next, you're going to have to go below that line in terms of cost cutting. So that is a message that we have shared internally with our economics colleagues to make sure that we're not getting too excited about anything like a V-shaped recovery or anything like that. We do think that it is going to take quite a bit more cost cutting before we get to the other side of this crisis. Now, that has some implications for when will the ratings stabilize. And I'm going to start at the bottom of this slide. So if you look at the bottom of this slide, this shows you our negative outlook and negative watch rates. Normally, negative outlooks and watches together should be about 12% of the ratings. Should be 10 to 15, somewhere in there, about 12. So. Now, at the start of this crisis, it was already at an elevated level. If you add triple Cs, who by definition are in a very sort of fluxy state, you are now at basically 37%, was the latest number we have, of the ratings we have outstanding, which is, it's almost triple, if you like, the standing rate. The outlooks alone on watches is double, more than double, the rate that we would normally expect to see. So that then poses the question with that, and we've never had, on the global portfolio, we've never had that level of negative outlooks. So then you say, okay, so, but you've done your forecasts, you've 700 downgrades, hundreds more outlook revisions. Does that mean that we're kind of done with the negative rating action? If we stick to the curve, will the ratings stabilize where they are? I think there's two things for this. One is the conversion rate. So how often do negative outlooks actually end up downgrading, which we'll talk about in a second. The other is more generally, what are the likelihood of better outcomes than we've assumed and the likelihood of worse outcomes than we've assumed? And it's rare that you would ever look at a rating agency and have them considered to be the glass half full party in the room. But I think it's probably fair to say that outperformance of our trajectories on a sustained basis, we think is still reasonably unlikely. Even with those charts you saw a few minutes ago, it's not massively better than we were originally predicting. It's a little bit better in cases, but there's not a fundamental change in that trajectory. Equally, it's very difficult to say that any trend right now is going to be sustained. Here in the UK, we may be going back into, we're already in sporadic regional lockdowns. We might go back into a wider lockdown later this year. It's very difficult to say with certainty that the trajectory that we're seeing just now can be maintained. So that then poses the next question, which is, well, what about the conversion rates? What would you normally expect a rating on a negative outlook to do? So we did an exercise here. The answer to the general question is, how often do negative outlooks convert to a downgrade? It's about 50 to 60% of the time. So say half the time. If you're on negative outlook, half the time within 12 months, your rating would be downgraded. Now, you can look at that and say, do we think we'll have a higher conversion rate in this environment or a lower conversion rate? And I won't bore you with all the thought process behind this, but our conclusion at the moment is that probably it will be slightly less. There'll be a slightly lower conversion rate. So what we did as a hypothetical exercise, and hold one number in your head, which is 700 downgrades globally so far this year. So we looked at what would the negative outlooks convert to based on different conversion rates. And we took the acute sectors, which is the retail, leisure, transport, oil and gas, entertainment, worst affected sectors who were 2/3 of all the actions through the main part of the crisis, 2/3 of the actions, the acute sectors. And we said, okay, let's put them in one bucket and apply a certain conversion rate to them. And let's take all the other sectors, telcos, utilities, food retail, everything else, put that in another bucket and apply 30, 50, and 70% conversion rates to them. There's a third bucket here. You can see stable outlooks. Stable outlooks, roughly 5% chance in a normal course of events that a stable outlook will get downgraded from stable. So relatively small percentage, but it's a large part of the portfolio. It's still the bulk of what's left of the portfolio. And I think the message that we wanted to get across from this analysis was a lot of people are very focused on those acute sectors, retail, leisure, transport, so on. But even if you assumed that they had a 70% conversion rate and all the other sectors had just a normal standard 50% conversion rate, you would still see more actual downgrades and almost certainly more dollars of debt downgraded from non-acute sectors than you would see from the sectors that everybody has been, to some extent, obsessing about over the past few months. So that we thought was an interesting way of thinking about what types of downgrades are going to come, as well as what the timing is. The short answer on the timing is we're seeing some stabilizations just now. We're seeing some triple Cs actually making it back into low B category because they might actually have got past the worst. We don't expect to see wide-scale stabilization of ratings over the course of Q4. We think it's going to be difficult, as I say, to be sustained in a trajectory over that time. So we would expect them to probably take into next year for us to start stabilizing. I did talk to my colleague who runs the bank group before this conference, and we did have a discussion about timing on stabilizations there. I think our bank colleagues, I know as treasurers, you're interested in what's happening to our bank ratings as well. I think there was a sense there that there might be more scope for our outlooks in the banking sector to shift. The caveat to that, of course, right now is that with Brexit, that's a very large factor in how we look at our UK bank ratings as well. So they probably, amongst all of the bank outlooks at the moment that move to negative as a result of the pandemic, are possibly going to be amongst the slowest for us to see stabilization there. So I believe that is, oh, I almost forgot, best and least best treasury responses. This is the same message I deliver pretty much every time with one addition. Good communication, good two-way communication is always extremely important. We do appreciate that it is really unprecedented times, lots of things for treasurers to be doing. Good communication with your rating agency, we appreciate as a call on your time. The analysts are conscious of that. They're conscious that they and you are all working in complex and reduced circumstances. So we do make sure the time that we take from you is used wisely, but do make sure there's good communication there. Have a plan B. So particularly when we look at people who are talking about maybe disposals as part of their response, there's always a lot of execution risk around disposal. So it's interesting to hear what types of plan B might be there. And always make sure that you are on top of your liquidity position. That can catch you out. The one piece of feedback I would give relative to least best, this does happen in crises. When I was, I used to run our utility group in the US, and we had a run of very, very big defaults about 17, 18 years ago. And I was struck then, there were a lot of treasurers in the utilities that had never really seen a sort of a situation where there wasn't a queue of bankers outside their door. and they were very much dislocated by the process of finding themselves in a crisis. In their cases, it was because they'd invested in unregulated generation, and deregulation in the market had made things very volatile, and it ended up with a number of utilities getting into trouble and very rapid changes in their credit rating. And we have had instances where companies that were really quite solid investment grade names have experienced quite a rapid turnaround of fortunes in all of our regions. And there it is important that you are conscious and thoughtful about your interaction with the rating agencies, in particular when it talks about liability management, because as I mentioned earlier on, the single most frequent default events we've seen recently have been distressed debt exchanges, where companies will essentially swap their debt either for less debt or swap their debt for debt with less onerous coupons that we would count as a distressed exchange. And if you're having a discussion around liability management with a rating agency, do make sure that you do not leave them with any kind of erroneous picture of perhaps a debt exchange that might end up sounding a bit more like a default than you would be used to, simply because it's terra incognito at this point. So that was my prepared remarks. I'm going to look into the chat room and see if we have any questions. Okay, question one, what's the risk to the banks? Again, caveat here, I'm responsible for our non-financial corporates. As I said, I mentioned to the head of our bank team, I asked them what their thoughts were on the bank portfolio. At the moment, what is dominating the rating outlooks for the UK banks is really Brexit. What we are seeing for the other banks is we do see potential, if the non-performing loans do not spike in the course of this year, for them to display that they can actually get past the worst of the crisis, and there might be some stabilization there. We do not see anything like a repeat of the global financial crisis, where you saw step changes and category changes in bank ratings. Certainly don't see that at the moment. Will government debt crowd out private sector borrowing and lead to an increase in rates and risk for corporate debt? Well, it's interesting. We're kind of almost seeing the opposite. What we are seeing is that government debt, and we're seeing this in a lot of the mechanisms where the government comes in and either buys bonds or more directly supports the marketplace, that ultimately is trying to push private sector investors, or one of the elements is to push private sectors further down the curve, so they have to buy double Bs and single Bs. It also means that the pricing curves of investment grade corporates don't balloon out, so people can actually raise debt at a reasonable level, so that the secondary market pricing doesn't start setting unpleasant precedents for pricing curves. So we don't see that actually leading to an increase in rates and risks for corporate debt at the moment. There's a question as to how sustainable it is, almost because of the opposite, because it is rather suppressing the cost of debt, and it is pushing investors into ever riskier parts of the debt spectrum. Question three, how do the sector's projections compare across other countries, or is it similar from most across Europe? Interesting element here is that we don't actually, the UK rated coverage tends to be mainly multinationals. So what you tend to see, I'm just checking how much time I've got left here. We've got 5 minutes left, that's good. Yeah, so the UK rated portfolio, we have some largely domestic names. We have some domestic names in the retail and in the leisure sectors, where we've already taken a fair amount of action. Generally, the UK rated portfolio is multinationals. So they tend to have a similar picture as the other Western European countries. So there's not much of a distinction between the UK and the rest of Europe in that sense. Question four, should corporates be trying to talk more frequently to their CRAs? Again, it really is, it's about setting a reasonable frequency. You don't want the next time you speak to your CRA to be immediately after some bad news has been shared with the market. I'd probably just limit my comments to that. If you do know that there's something unexpected and bad in the pipe, particularly, I mean, I used to say nobody wants to find out about that as an analyst at 7 in the morning looking at the Bloomberg terminal. Obviously now it can be even more surprising when you hear bad news about one of the companies that you're covering. So do make sure, if particularly if there's bad news, that you are not letting your CRA analyst from any of the three of us get surprised. How much do you think equity and debt capital markets have changed to allow companies to improve their capital base through raising new equity and longer term debt? I think this really has been a proof of extraordinary resiliency in the debt capital markets and to a fair degree in the equity capital markets as well, that this much capital has been made available. I think one thing I would just caution is that the trajectory of the ratings and the starting point, it's really important to remember the starting point was a very long run negative trajectory in corporate credit quality, is there has been liquidity made available, substantial amounts of liquidity. The market has done an extraordinary job, and we just have to be careful that that isn't going to be disappointed, as it were, with new investor classes that have come in. Maybe to end on a happy note, we are looking at our default forecasts. I think we're publishing today. We've already said this publicly in general terms. We are coming in at the low end of our default expectations in percentage terms. And that's the case in both the US and in Western Europe. So, and they're coming in substantially lower than in percentage terms, not in dollar volume terms, than they did in the global financial crisis. So there is a sign that the default rates are actually a little bit lower than they thought they were going to be. They're a little bit more towards the low end. We, however, see them extending out a little bit into 2022. And with that, I think we are now almost at the end of the session. I'm going to pick up my cheat sheet of housekeeping notes. So I have to thank the audience. So thank you for your attention. Thanks for all the good questions. Any other questions, obviously feel free to contact us. You can contact us via us in the virtual networking room and in the exhibition hall. So please visit the exhibition hall. Please do also fill out the session survey, which I believe is also at the bottom of the screen here. It's right next to the Q&A box. And also, this is the last of today's live sessions at ACT AC20. We'll be back with more live content tomorrow. But again, do visit the networking lounge. The last time I looked, there was something like 500 people online in the middle of this afternoon. A fair number of them were in the networking lounge. So do check that out. Otherwise, I would just say thank you again for your attention. And any of the materials that we mentioned today that you'd like to see, just contact us via our stand in the exhibition hall. Thanks very much.